Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the loonies' 9-week climb. The Corbett reports James Corbett on whether China can avoid recession. Juggling dynamite blogger Danielle Park believes Canada should follow California's alternative energy example. We'll talk to Ross Clark right after this.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Oh, it's a pleasure to be with you, Jim.
You were saying just before we went on air, Canadian markets are in very rare space right now.
Well, both the equity markets and the currency. Canadian dollar, 9 consecutive weeks on the upside. I think looking back on my database, I see we might have done that in 2003 coming off the bottom, and at the top end of the market back in 1991. This is rarefied air to have that type of strength. And, the catalysts, we had 2 catalysts this week. First being that the Fed in the U.S. Was very dovish in their comments out of the meeting, with the talk being that we won't see anything in the way of rate hikes in the U.S. probably well past the spring into the fall. So with that, U.S. dollar took it on the nose on Wednesday and Thursday, stabilized on Friday, but the Canadian dollar had a pretty positive week, up 2 cents in the last day and a half. Did a little bit of a reversal towards the close on Friday, but it was a pretty impressive stretch we've been on. Now, this is, from my perspective, its 3rd week in a row of being in overbought conditions, and we brought this up over the last few weeks that typically when you are this well along in a bear market, which really started in early 2013, it takes you typically 2 to 3 weeks to create a good overbought before you're ready to roll over and go down and retest the lows. So from a technical perspective, I would say the first week going forward now with a lower low would be the catalyst for us to give back a good 60 to 80% of the decline. And we're also, not just overbought, but we're up against the 200-day or the 50-week moving average. So it's a natural spot for resistance up here.
Why was crude climbing over this period and bringing the loonie higher with it?
Well, I mean, the two, they do walk in tandem. There's no question about that. And you went from extreme oversold conditions with a lot of short positions on. I think, the first part of that move into the mid-30s was definitely something you would expect to see. Right now, we take a look at the contango here, which is the spread between the front months and the further outs, and you can see that the bidding for storage right now, near-term storage, has slackened off quite a bit in the last week or so. So, the looks as though that's been of assistance to the market. From my perspective, I do think that this market's getting a little long in the tooth right now, and just like the Canadian dollar, could be ready for a decent rollover and pullback.
I know when crude goes up, the Canadian dollar goes up. Canada's a gold mining nation with an improvement in gold mining stocks. Would that be enough to bring up the dollar?
I don't think that the gold and the Canadian dollar have that tight a relationship there. I mean, as far as the resource sector is concerned, the miners, independent of just gold, when you get into copper and the base metals, I think there you probably have a much bigger influence. And when I look at the base metal side of things, copper prices were trading around $2.29 as of the end of the week, just like everything else, up right around its 200-day moving average for resistance. So, yes, commodities as a whole tend to move with the Canadian dollar, but everything's up against resistance for now.
Was it a brighter week for the major stock markets?
Pretty solid week across the board. You end up now with the TSX, the S&P, the Dow up on the year. TSX has definitely been outperforming. It's up over 4% on the year versus just a fractional percentage point moves on the Dow and the S&P. But on top of that, the Canadian dollar has been outperforming. So Canadian side's been doing very, very well. Thing that we have to watch for being the presidential election year and being the 8th year in the term, the strength that you would normally see as we come out of February in through March, that typically takes about 4 weeks from the interim lows that you put in February until you get up to the top end of the range. Well, actually it's 5 weeks. It's 26 to 29 days normally. So that will take us into next week.
Ross, thanks for chatting with us.
Always a pleasure to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up next, James Corbett on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he has lived and worked since 2004. Whereabouts in Japan, James?
It's about halfway between Osaka and Hiroshima on the west side of the main island.
And I understand it's a lot like Penticton.
It's not too far, I guess. Yeah, it's certainly hot in the summer, although it is probably much more humid than Penticton. It is a humid climate, which I'm not used to being an Alberta boy myself.
But you do have peaches.
We do, actually, yes. Very famous in my little area here. Peaches, and I think that's pretty much the most famous part of this area of Japan.
Right now, James, our famous North Korean dictator, Kim Jong-il, is making noises about using nukes because the U.S. and South Korea are holding their annual military exercises. Are people in Japan nervous about this, or are they used to his noises?
A little bit of both. I think the political class, at least, is making noise about this, as you would expect them to do. I don't think the average person here in Japan is on the edge of their seat in fear about this, because, again, this nuclear dance has been going on for over a decade now, and I'm going to go out and make a bold prediction that North Korea is not going to start nuclear Armageddon. Not only because I don't think they're really capable of it at this point, but also because it would be suicide. So I don't think that that's really on the table, but it is a negotiating tactic that they're using, and I think a lot of people understand it as such. Again, maybe in South Korea people are a little more nervous, but even there I think people understand that this is more about drumming up international attention to the issue of North Korea rather than actual threat.
Do you think the U.S. would use atomic weapons on North Korea if they did go nuclear?
If they did go nuclear, I suppose all bets would be off the table. Again, I do not think that's a likely possibility, but at any rate, we do know that the South Korean military and the U.S. military hold joint exercises every single year on the Korean Peninsula that in recent years have involved the dropping of dummy nuclear munitions, really, from B-52s or B-2s that would be capable of actually deploying nuclear ordnance. I think that's more meant as sort of a message than it is an actual threat. But the North Koreans, of course, use that every single year as an example of the belligerence of the U.S. side in this, and perhaps rightly so. It is an extremely large military exercise that they conduct every single year, and every single year, like clockwork, the North Koreans ratchet up their rhetoric in response to that. And interestingly, in the Western media, only the response is ever talked about. The military exercises that provoke that response are never talked about.
Japan recently instituted negative interest rates, negative 0.1%, and I've heard perhaps that they may even lower them more?
It is a possibility, but I believe that in recent weeks they've been ruling that out, and certainly they haven't made the move yet if they are going to go more negative. The markets, to a certain extent, are deciding that as the yen is, again, considered a safe haven, one of the safe haven investments that people have been flocking to. So, in fact, it's been driving the effective value of the treasury sales here in Japan down. But interestingly enough, from what I've heard, the BOJ is now not considering further negative at this point.
What's been the reaction of the average person to losing money when they put money in the bank?
Well, it hasn't filtered down to the consumer level yet. This is still affecting funds that are parked at the Bank of Japan itself. And so far, banks haven't passed that on to the consumers. So I don't think it's reached that level yet, but people are certainly, I think, have always been a little bit nervous in the post-World War II era about keeping money in banks, because there are still people alive today in an increasingly aging Japanese society that remember some of the bank destabilization that happened in that post-war era. And there is a phenomenon here in Japan called Tantsu Ryokin, which means wardrobe savings, that has been a phenomenon for a very long time, where a lot of older people in that older generation keep a certain amount of cash and other valuables stuffed away in their closet, because they don't trust banks that much. So it's JGBs, Japanese government bonds, and cash stuffed away in the closet has been traditional savings for Japanese people. So I think that phenomenon is really it is already and probably will continue to increase amongst the younger generation that may not be so used to that concept.
How big is cash in Japan, and how would they react if governments tried to restrict access to cash?
Cash is king in Japan still. There are electronic forms of payment, but cash is still used daily in all sorts of transactions, including, and I mean, people will buy cars in cash, and the car dealership will not bat an eyelid about it. It's still a very common form of payment for all sorts of things, and there isn't really a checking system here or things of that nature. So, other than credit cards, which are occasionally used in certain transactions, cash is generally used for most day-to-day purchases.
And debit cards?
And debit cards exist, but again, they're used for ATMs, but not so much in store. Again, it's not so common to be using debit cards. There are loyalty cards issued by various stores that can act as debit cards that are gaining popularity, and there are smartphone wallets and things like that are gaining popularity, but still cash is most used. So I think that there is definitely going to be an interesting dance here in the next several years, as Japan will, like all Western developed nations, start phasing cash out more and more. I think there's going to be an interesting pushback from the Japanese population, which signs are already out there that the amount of 10,000 yen notes, which is the largest yen in circulation, which is equivalent to whatever it is, $80-something at this point, there is an increasing amount of them out there in circulation. So it looks like people are already starting to hoard them in preparation for whatever crackdown or tightening might be coming.
Does Japan have legislation that would allow bank buy-ins, or as we would probably call them, bailouts?
I don't know about the specific legislation here. All I know is that in the wake of the popping of the bubble in 1990, that there have been a number of banks and corporations that have been kept alive by governments, even though they do not have the sufficient amount of funds to really cover their credit losses. And those zombie banks or zombie corporations have been part of the problem of the post-bubble years. So I don't know if explicit bailouts are even really necessary in this environment, because the government seems to be willing to look the other way and or just change reserve requirements when it is as necessary to preserve whatever kind of financial institution needs to be preserved. But at the end of the day, I mean, regardless of how they do it, they certainly are, they have shown themselves for the last 2.5 decades to be in favor of propping up any financial institution of sufficient size that looks like it's in trouble.
China, are they into economic recovery? Are they going to be an economic disaster? What's the picture there?
Well, they are slowing down. There's no doubt about that. Everyone agrees on that. Even the Chinese official numbers agrees on that. So there's no doubt that the growing behemoth of the Chinese dragon has certainly tapered off in the last few years, and seems to be falling off a cliff at the moment. And perhaps the most obvious sign of that is the record sales of U.S. treasuries that China has been engaging in. For example, $100 billion of foreign exchange reserves sold in January alone, as part of an effort to try to prop up the yuan, which, although it had been undervalued for a very long time, as has been famously pointed out, in the last few years, especially with the takeoff of the U.S. dollar in the last year and a half or so, the Chinese yuan has maintained almost a stable peg to that dollar and has started to become overvalued. So now they're trying to prop the yuan up instead of devaluing, and they're doing that by selling U.S. treasuries. So they're obviously in a pretty precarious situation right now, And the real concern here is that the capital outflows from China are only going to increase as the nouveau riche in China start to get scared about what's happening in China and their ability to really use that yuan that they have in their bank accounts. So they're going to start trying to funnel it out of the country at an even faster pace. However much capital controls the Chinese government tries to put on them, we've seen that those aren't very effective controls.
We're speaking to the Corbett Report's James Corbett from Japan, taking a look at West Side Vancouver real estate prices. $2 million houses selling for $6 million, sight unseen by Chinese investors.
Exactly right. Real estate has been the primary vehicle through which a lot of these Chinese millionaires have been funneling their money out of the country, and they have developed a number of schemes to do so to get around the Chinese government's capital controls. And I would assume that that's going to continue unless and until somehow that avenue is closed down to them. But it doesn't look like the BC government or the Canadian government is particularly interested in clamping down at the moment, because that might be the end of the housing bubble in Canada, and that would obviously be quite ruinous for the Canadian economy in the same way that it was for the U.S. economy back in 2007, 2008.
In China, I thought one of the ways to get around the one-child policy to be allowed 2 children was to invest in foreign real estate. That would allow you to have an extra child.
I believe you're correct about that. There are a number of different exceptions that have been added over the years, including for rural couples and all sorts of other things. So that might be one of them. At this point, again, it's now that they've formally changed those rules so that there is no formal one-child policy going forward. I don't know if that still holds or if there's still any perceived value in that. But certainly there has been so many holes in that system for a very long time that it's been effectively null and void.
Is China effectively working on the environment? Because I've heard air pollution is so bad in China, their average life expectancy has fallen by 5 years.
Yes, that doesn't surprise me given the types of scenes that we've seen coming out of Beijing and some of the industrial centers there in China. Certainly that has fallen to the wayside in the event of their large-scale industrialization and ramping up of manufacturing in the last couple of decades. And that is I think one of the political pressure points that Beijing and President Xi Jinping really understand is a really potentially explosive issue for the Chinese government. It's become more and more of an issue in recent years, and there are obviously there's a lot of concern about it, and there's daily readings printed in the newspapers about the PM levels, the particulate levels in the air and things of that nature. So it is a political issue, and the Chinese population, as it grows richer, can, in one sense, afford to have that become a political issue. So I would expect at the very least the Chinese government is going to do what they can to try to eradicate the perception of that problem, whether that means sweeping it under a rug metaphorically or perhaps even literally somewhere in more of the rural areas of China. But certainly it is a political issue that they are concerned about.
Is China counting on that $30 billion pipeline from Russia to supply all of their oil and gas needs, or would they still need petroleum products from Canada, including liquefied natural gas? Oh,
I think there's no doubt they're going to continue to try to seek out oil sources from a lot of different places. I think the Russian-Chinese pipeline is a convenient source for them, and certainly one that might be more stable against geopolitical risks that might eventuate in response to a geopolitical situation. If there's a president elected in 2016, for example, that's unfriendly to Chinese interests, I think they'd want to work around the U.S. and its close neighbors to try to find other sources of oil. I think they're really just trying to source as many different ways of getting oil as they can at this moment. But in the light of a slowing down economy and plunging oil prices, the scramble for oil may not be such a pressing concern for Beijing at this point. But looking long term, I think they're just interested in securing as many sources as possible, including Canada.
If Donald Trump is elected president of the U.S., how would that affect trade with China?
Well, I mean, it's difficult to say because there has been no clear vision of what a Trump presidency would look like. There have only been sort of amorphous statements with not a lot of policy backing to them. But given the tenor of those statements, if they are to be trusted and if they do reflect what President Trump would put into effect, then certainly there will be a cooling in Chinese-U.S. trade relations, because Trump has made numerous statements that could be interpreted as being protectionist in nature and saying that China is basically winning the game, as it were, in trade. So it sounds like he's going to try to take a more protectionist stance and try to erect more barriers to trade with China, which would cool the relationship, one would imagine, and may in fact be part of what China has been baking into the cakes for several years now, trying to establish their own economic sphere, as it were, with the Silk Road and the new economic zone that they're trying to establish in Eurasia and in East Asia and their connections around the world. They're already working on trying to get out of the position of being essentially America's supplier and trying to be a supplier to the global market. And I guess they're already working on trying to circumvent that problem.
I know China and India have a free trade deal. There were talks years ago about having a common currency. Are they still talking about that?
I haven't seen that come up recently, but it is conceivable that the yuan will be seen more as an international currency, if not a shared currency among different nations, but at least more of an internationally viable currency. Again, especially depending on the way that the Asian Development Bank, the AIIB, the Asian Infrastructure Investment Bank, and the new BRICS Bank, depending on whether or not they continue to transact in dollars or whether they will source new funding in yuan or some other currency, I think that could have an effect at least on China's relations. I don't know if that will have a global effect per se, but at any rate, it could create trading relationships that are more likely to be resolved in yuan rather than dollars.
How is the BRIC, Brazil, Russia, India, China trading bloc working out right now?
I don't see a lot of cohesion among that bloc at the moment. And in fact, I think the creation of the AIIB, the Asia Infrastructure Investment Bank that Beijing was putting together last year and is starting to come online this year, is to a certain extent perhaps a rebuke of the BRICS, which of course I believe it was also early last year, officially started that new BRICS Bank. What's the point of the AIIB unless it's to basically have a more Chinese-controlled bank than the new BRICS Bank? So I think I still think that the BRICS concept in general is more of an idea in theory and than it is in actual practice. But at any rate, it's still going, and we'll see if anything continues to eventuate from it. But Brazil certainly is in no position at this moment to be contributing anything useful as part of a trading bloc, as President Rousseff is in danger over the scandals that have been playing out in Brazil. And India is still not particularly living up to its promise of the last decade, let alone this decade. China slowing down, as we say, and Russia has actually experienced a slight boost in its foreign exchange rates as a result of the kind of the goodwill, the peace dividend from their withdrawal from Syria, but still Russia's economy is in a perilous position. So I don't think there's a lot of bright news coming out of the BRICS pact at this moment.
Is there news of labor unrest in China? I heard for the first time ever they laid off 1.5 million coal workers from an unproductive brown coal mine that wasn't doing much, and most of the workers were just standing around anyway. I
haven't heard about labor unrest as an issue in China. That's not to say that it doesn't exist, but the news that's being highlighted at this point is the formal rubber stamping of the new 5-year plan that the National People's Congress just ratified earlier this week, which again is not to be it was to be expected, because the National People's Congress is nothing but a rubber stamp for whatever the Communist Party wants. But still, this new 5-year plan, I'm sure, is going to be the focus of the government at this point, and they're going to be putting all their propaganda efforts into making this seem like it's going to be whatever is going to drive the Chinese economy forward from this point. So I haven't heard about the labor unrest issue, at least certainly not from Chinese sources, although I suppose we wouldn't expect them from that.
And of course, China predicts they'll have 6.9% growth. Do you think a year from now that's exactly what they'll report? Yes, probably exactly. Yes, no, I believe the range they're predicting for 2016 is now 6.5 to 6.9%. So yes, I would be surprised if they come back with anything other than 6.9% for 2016, regardless of what the actual number is. Was there anything in the 5-year plan that caught your eye? It's more of that political mealy-mouthed stuff
that it really depends on which way it's actually implemented. But one of the things that people have noticed that became something of an online phenomenon recently was this talk about a new social media credit score, whereby people would be monitored on social media and would be given a score based on whether or not they are sufficiently pumping the party line on various issues. And if they are, they win points, which will go towards various benefits and perks that they can get from the government, like the permission to travel abroad and things like that, which, again, should be pretty chilling. Again, that, of course, things like that always depend on the implementation, but just the idea of things like that being floated as part of a 5-year plan is pretty amazing.
How many points do you get for posting a picture of your dinner?
That's a good question. That might be neutral. I don't know if they care about that.
James, how can people subscribe to the Corbett Report?
They can go to CorbettReports.com. That's CORBETT report.com. All of my videos and articles and interviews are there available for free download, and you can support my work if you care to at the support tab. And you can also go to theinternationalforecaster.com, theinternationalforecaster.com for more information about the Forecaster, which comes out twice a week and is loaded with 20 to 30 pages of financial and market information.
James, thanks for being on This Week in Money.
Thank you for having me.
My guest has been James Corbett, publisher of the Corbett Report and editorial writer for the International Forecaster. He was speaking to us from Japan. Coming up, Danielle Park on This Week in Money.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to This Week in Money, Danielle.
Hey, thank you, Jim. Happy March break.
Yes, and I hope everything is happy and well. It's pollen season in Vancouver. Winter never did arrive. It stayed up on the ski mountains where we have 3 meters of snow.
Yeah, and lots of talk about February being off the charts in terms of the scientific terms for describing the level of Earth warmth in the month of February. And March is so far, there's no snow here at all in Ontario, so gives you some idea.
The U.S. Fed did not raise interest rates earlier in the week. They have been hinting that they're going to do it sometime this year. Will they ever do it again?
Well, our take all along has been that for sense of pride and sense of keeping up face and trying to defend the policies that they've been rolling out over the past few years, that they were going to continue to try and hike rates. And it was a question of when the chicken out factor came, because clearly the economic data has been weakening, not strengthening. Deflationary targets have been increasing, so they have missed their mandate on inflation. Now, when they look at full employment, they make some very esoteric measurements and suggest that they're hitting their target, but everybody in the real world knows that the truth is, even though they've effectively hit their target, the labor force participation rate is at record lows today for many decades. So it's just one of those things where the theory is, that everything's recovering and that QE has worked and that they should be into a normalizing rate environment. The reality is something profoundly different. And so it's a question of how they back out of, their insistence that their policies have worked. How do they defend that in the face of all this data? So we know that they want to at least continue to signal that they believe they've been successful, so I think they will want to hike again. Perhaps now it'll be June, but, if we get a significant downturn in global markets over the next quarter, then that indeed could be off the table as well again. Because increasingly the world has become this interconnected, totally coupled, correlated financial mess, right? So debt and equity and markets and currencies, everything in global trade, everything really has mushed into one pit. And in doing so, they can say that they're the central bank for America only and that they don't pay attention to what goes on in international markets, but the reality is something different.
Europe has adopted negative interest rates. Japan has them. What are they, and what are they trying to do?
So there's different varieties of them, but certainly the beginning ones are that the central banks charge banks for leaving money on deposit with them. And the idea there is that there's an incentive, because the typical or traditional system was that banks deposited their excess reserves with the central banks, and they could draw down against them when necessary, but they were paid, a small deposit rate for keeping their capital in the central bank, keeping liquidity sort of in one central spot. And then as this has morphed over the years, when they kept cutting rates, part of the incentive was that if they can earn less on rates on deposit with central banks, that banks will then take money out of excess reserves out of central banks and loan them to the general public. And they've been on this kick, central banks, that they want to promote consumption through more and more loans, right? But as we've got to the end of the appetite for loan taking, and indeed for banks to lend to people who can't pay them back, they've had this growing tendency to keep deposits on deposit with central banks and just sort of taking the easy money. So taking the modest interest, even as interest rates have come down, taking that modest positive carry, and then, where making up for their profits instead of their traditional spread lending business, making up their profits by speculating with whatever money they have left. So, that involves trading and high frequency trading and buying and selling commodities and stockpiling and storing and fixing prices and everything in the world. That's their main preoccupation and has been over the last, decade, but certainly over the last 6 years since sort of the 2008 collapse. So, trying to force more capital out into the traditional banking system and off the deposits with the easy carry, if you will, at the central banks. The theory is if they cut rates to zero, would that do it? No, they kept their deposits there. So then the next iteration of this is, well, if we charge banks, if we charge them to have money on deposit with the central bank, surely then they won't want to continue just stockpiling cash, and they will actually look for ways to lend to the general economy. But that's all a thesis that has no transmission in reality, because banks look at prospects for reward and say, we've already loaned tons of money to anyone with a decent credit or anyone that's interested in borrowing. What we've got left are financially challenged people who already either have too much debt or have too little income to borrow more. And so they have very little business incentive to want to seek out those people and advance more loans. And at the same time, you've got a population who has become sick on debt over the past many years and is literally revolted at the thought of taking on more. So you have this drive to try and increase their savings as interest rates have come down, and even charging banks for deposit at the central bank is not pushing more loans through the economy. So they're really at the end of their ability to tweak demand through lower rates, and the negative rates have this very negative effect on bank profits. Oh, the horror, the horror. After all, central banks are there to support banks. And the reality is that the financial community in general is starting to raise the riot about this whole negative carry of having cash, because they literally, they're saying, well, we're going to have to make up the easy money we were making for these deposits. If we're going to have to pay, we're going to have to pass that on to consumers somehow. And the question is, how are we, the consumers, going to absorb the cost of this in the banking system? So it really starts to upend. We've seen this in Japan, where they've had negative rates, and it's causing mayhem in the pension plans, because pension insurance companies have these long-term obligations, and typically they buy bonds to match to those obligations so that they have the money there when the payments are required. And in this environment, everything's turned upside down. And the solution, by the way, is not to take on more and more and more capital risk so that you have an 80% chance of blowing the money up and having no money there to match these commitments in the future. that is not a good trade-off, to have a small prospect for winning the lottery, this whole winning mentality, double down with great risk and maybe you'll win. The probabilities of that plan working out are just disastrous. And even if retail people don't understand that, or mom and pop investor don't understand that, professionals that work in the business and manage these large pools of funds do understand that, and they're looking at the mathematics of this and saying, this is absolutely bonkers. Like, this has to stop. We can't keep doing this. We won't be able to fund all these promises that we've made. So it's quite a mess at the moment.
We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. There's been some talk that Canada, Israel may adopt negative interest rates. Is that a good idea to follow what doesn't seem to be working all that well in Europe and Japan?
No, it's a disaster. But unfortunately, the central bankers of the world all went to the same schools, all learned from the same textbooks, and all have the same playbook. That's all they have. They aren't innovators. They don't have, magic tricks up their sleeve, even though that's presented like that to the public. All they ever had was lower rates to try and spur some more spending. And once you're at the bottom of that, there is nothing else. So you've got this paralyzed government in many of the world economies, in the Eurozone with the standoff and the stress about, who's sharing the liabilities there. You've got the potential fraction in the Eurozone. You've got this stagnant standoff in the American Congress where nothing can be accomplished. And so the only game in town has been this manipulation by monetary theorists. And, although they've been able to keep asset markets buoyant for a very long run here since the 2008-9 collapse, it's always been a game of diminishing returns. So, they are continually looking to the governments and saying, you guys better come up with some magical tricks. Of course, the governments are not in power to really drive growth around the world. It's really corporations that need to do the, figuring out where, in a perfect world or in a healthy world, not perfect, but healthy, it's, wherever reasonable profits can be made, corporations are supposed to take their cash and invest it and create jobs, and you're supposed to have free market forces dictating, where capital flows. In this price fixing and money fixing environment we've been in over the past 15 years in particular, central banks keep trying to, juice demand, and what you get is money flowing to the wrong spots where it isn't really needed, like a ton of oil and shale production, for example, much more than is currently needed in the world. And, all this talk about will they freeze production at record highs, there's a bounce in the price of crude in the past months, and the general thesis is, well, there's some talk that Russia and, OPEC's going to get together and they're going to agree on some kind of a freeze. But that's a freeze at record levels of production, and that does nothing for the fact that we've already got these record levels of inventory sitting around. So in a world of weak demand. So instead of all the capital flowing into these sort of malinvestment spots, it's better if you have a free market that can take cues from price, which, again, the central banks have to get out of it. Governments can direct some policy, tax breaks, tax incentives, that sort of thing to push and prod behavior, but ultimately the math has to make sense and supply and demand has to be in charge again. And so cutting to negative rates in Canada will do zero. We need to reformulate our economy into a smarter energy system, which the new Prime Minister is talking about. I put up an article today about California because they have a ton of water problems, clearly, but they also have had this long tradition of energy revolution through Republicans and Democrats of working towards this carbon neutral platform of developing wind and solar plants, of rooftop installation, of getting the tax credits for solar panels for homeowners, and all this stuff is really driving a huge renaissance in that state in terms of job creation. So you've got a lot of people who were, as we know, have been underemployed since the last Great Recession in the world, and the jobs that were available in this part of the world were too often, fast food and dollar store type jobs, which were, just a work, like a poverty wage basically, and, no great prospects for the people involved. Whereas in California, they're taking a lot of those people and retraining them to be, installers in the solar industry, and they're going from, $10 an hour to much more healthy wages, and they are retraining and, feeling productive again and getting to actually set aside money for savings for the future, retirement benefits, all that sort of thing again. So it really is a shining example. Instead of trying to slash rates and force more loans on the loan sick crowds, which is what the rest of the world is trying to do, you can incent behavior, you can incent business and consumers, and retrofit to a much more sustainable infrastructure. And we've talked about this before, Jim. It's really a no-brainer, but California really does have a blueprint for how it can be done in many other parts of the world. So I'm really encouraged by that and hopeful that, we'll get some more sane developments along those lines. Now, if you get a climate denier come in as the leader of the United States, that's going to be a major setback, in the next election. Because, I was thinking about this, we need tolerance for different views and all that, and I'm all for, a very inclusive and diverse people and views is all great. But arguing that there's no such thing as climate change is not the same thing as saying you believe in a God. You can be a devout believer in a God of your choosing, and that's really a personal belief that no one else can actually prove that you're wrong in that. But to say that you don't believe in climate change and that that's your main thesis is, defying all the science and all the evidence to the contrary. So it really is problematic if the leader of the free world comes in with that stance at this particular time.
The person behind the Tesla electric car, Elon Musk, says we should colonize Mars. Why is he calling for the colonization of that red planet?
Actually, it's funny you asked that. I was just reading the new Elon Musk biography by Ashley Vance, and the book goes into quite a bit of detail about why he has that impression. And, the dark side of it is that his concern is that we may have abused this planet far too long and too deeply to reverse it. And that as a fallback position, he thinks humans need to be able to colonize other planets. At the same time, he is developing these remarkable electric cars, which are revolutionizing the auto industry as we speak. The whole car manufacturing world is turned on a dime, and everyone's racing to roll out their next electric vehicle because of exactly the leadership and embarrassment that Tesla has been able to show them as a startup in Silicon Valley, versus a big Detroit car company and that sort of thing. But my concern would be, and maybe they're right. Again, as David Suzuki admits, we don't actually know for sure if we can reverse the damage that's been done, or if it is too late and that the world will be on a sort of crash course sooner than anyone had previously feared. But I think there's a sort of a justification that concerns me in this, and I've heard it from many people. It's a sort of a fatalistic argument that goes like this. It's hopeless. We'll never be able to change, so therefore we don't have to try, right? We never have to do anything smarter because it's all hopeless and none of it's going to work. And I always think that's a pretty lazy argument, and, kind of lazy in the sense of you never have to actually make any uncomfortable evolution yourself when you've come up with this fatalistic model. So I think there's a lot of bright spots. There's a lot of things that we can do a lot smarter. I'm not a fan of colonizing Mars as this sort of fallback position. I really hope that we can do a lot smarter things here than, because my take on that would be, well, we'll just go to Mars and wreck it then. Because if you're in this very destructive pattern of behavior and you're throwing out everything and don't care about your biosphere, there's no way to win that. It's like pouring water into a hole with buckets, you're always going to end up with an empty bucket, right? So I'm not really convinced of that, but then again, as I said, none of us really know how much time we have to correct some of the major environmental stresses currently going on the Earth.
Danielle, if somebody wanted to know more about Venable Park Investment Council Incorporated, how can they do so?
We have a website, venablepark.com, and there's years and years and years of archives of articles and clips and books and all sorts of things you can read about our firm and our philosophy and our approach. And then, of course, the blog is where my partner and I post articles and charts every day, strugglingdynamite.com.
Danielle, thanks for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. And that wraps up our show for this week. We'd like to thank our guests Ross Clark, James Corbett, and Danielle Park, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.